Imagine you work hard every day, save some money, and finally decide to invest it so it can grow. But after some time, you see the value going up and down. One day you feel happy. The next day you feel worried. You start thinking, am I doing the right thing or am I just guessing? This is where most people get confused. They think investing is like a game of luck. But what if it's not? Let's take a simple story. John is a regular guy. He saves a little money every month. One day his friend Mike tells him about investing in stocks. Mike says, "You can make a lot of money quickly." John gets excited and puts his money in. At first, things go well. The price goes up and John feels smart. But after a few weeks, the price drops. John panics. He sells everything and loses money. Now he feels investing is risky and scary. On the other side, Sarah also saves money. She also wants to invest. But instead of jumping in, she takes time to understand how investing really works. She learns that prices go up and down, but real value does not change so quickly. She stays calm when prices fall and patient when they rise. Over time, her money grows steadily. The difference between John and Sarah is not luck, it is understanding. And this is exactly what the book The Intelligent Investor by Benjamin Graham teaches in its first chapter. The main idea of this chapter is very simple. Investing is not about making quick money. It is about making smart decisions with safety and patience. Many people confuse investing with guessing. They buy something just because others are buying. They hope prices will go up fast. This is not investing. This is more like gambling. The book explains that a real investor always thinks about two things. First, safety of money. Second, reasonable return over time. That means you should not focus only on earning more. You should also make sure you do not lose what you already have. This sounds simple, but most people ignore it. Think about it like this. If someone offers you a deal where you can double your money in one day, but there's also a big chance you can lose everything, would you take it? Many people say yes because they focus only on the reward. But a smart person thinks, what if I lose everything? That is the difference. Another important idea from this chapter is the difference between investing and speculating. These two words sound similar, but they're very different. Investing means you study, you understand, and you make decisions based on logic. Speculating means you guess and hope for the best. Let's go back to John. When he bought stocks because Mike told him to, he was speculating. He did not understand what he was buying. He only hoped the price would go up. But Sarah, who took time to learn and think, was investing. The book makes it very clear that speculation is not wrong if you know you are doing it. But the problem is, most people think they're investing when they're actually speculating. This confusion leads to mistakes. Here is a simple example. Imagine you buy a small shop. You will look at how much money the shop makes, how stable the business is, and whether it can grow in the future. You will not buy it just because someone says its price will go up tomorrow. This is investing. Now imagine you buy a piece of paper that says you own part of a company, but you do not know what the company does or how it earns money. You just hope its price goes up. This is speculation. The book teaches that when you invest, you should think like a business owner, not like a gambler. Another key lesson is about behavior. Most people think success in investing comes from being very smart, but the truth is, it comes from being calm and disciplined. The market goes up and down all the time. If you react to every small change, you will make bad decisions. Think about Emma. She invests her money and checks the price every hour. When it goes down, she feels scared. When it goes up, she feels excited. She keeps buying and selling again and again. In the end, she loses money because of her emotions. Now think about Mike, who invests and then checks only once in a while. He understands that small changes do not matter. He focuses on long-term growth. He stays calm and does not react quickly. Over time, he does better. The lesson here is simple. Your biggest enemy in investing is not the market. It is your own emotions. Fear and greed can make you take wrong steps. A smart investor controls these feelings. The chapter also explains that you do not need to be perfect. You do not need to predict the future. You just need to follow simple rules. Protect your money. Avoid big risks. Be patient. Stay consistent. Let's connect everything with a small journey. At the start, John thinks investing is a quick way to get rich. He follows others and makes random choices. When things go wrong, he loses money and confidence. Then he starts learning. He understands that real investing is slow and steady. He learns the difference between guessing and thinking. He stops chasing quick profits. Finally, he changes his behavior. He focuses on safety. He becomes patient. He makes decisions based on logic, not emotions. Over time, his money grows, and he feels more confident. This journey shows that success in investing is not about luck. It is about mindset and discipline. One more simple idea from this chapter is about expectations. Many people expect very high returns in a short time. This makes them take bigger risks. But the book teaches that it is better to aim for reasonable returns with lower risk. Think of it like walking. If you try to run too fast, you may fall. But if you walk steadily, you will reach your destination safely. So instead of asking, how much can I earn quickly? A smart investor asks, how can I grow my money safely over time? In the end, the first chapter of this book gives a clear message. Investing is not a game. It is a process. It requires thinking, patience, and control. You do not need to chase every opportunity. You need to choose wisely and stay consistent. If you remember just one thing, remember this. The goal is not to be the smartest person in the room. The goal is to avoid big mistakes and stay steady. So next time you think about investing, do not rush. Do not follow the crowd blindly. Think like Sarah. Stay calm like Mike. And slowly, step by step, you will move in the right direction. Imagine two friends, John and Mike. Both save some money every month. One day, they decide to invest it. John quickly buys stocks that everyone is talking about. He feels excited when prices go up and scared when they go down. Mike, on the other hand, takes his time. He asks a simple question. What am I really doing when I invest? That one question changes everything for him. This simple idea is what Chapter 2 of The Intelligent Investor by Benjamin Graham is all about. It explains the difference between investing and speculating. At first, both may look the same. You put money in and hope it grows. But in reality, they are very different ways of thinking. Let's understand this in a very simple way. Imagine you buy a small fruit shop. You check how much money the shop makes every day. You look at expenses, profit, and whether people like the fruits. You think about how the shop will do in the future. This is investing. You are using logic. You are looking at real value. Now imagine something else. You hear someone say, fruit shops are hot right now. Prices will go up fast. So you buy a fruit shop quickly without checking anything. You just hope to sell it later at a higher price. That is speculating. You are guessing, not thinking deeply. This is the main idea of this chapter. Investing means you study, you think, and you protect your money. Speculating means you guess, you follow trends, and you take bigger risks. Now let's go back to John and Mike. John buys stocks because others are buying. He sees prices going up and thinks, I will make quick money. But he does not know what the company does, how it earns money, or if it is strong. Mike does something different. He looks at companies like he would look at a business. He asks, does this company make steady money? Is it strong? Am I paying a fair price? At first, John feels smarter because he sees quick gains. Mike feels slow, but after some time, prices start going up and down. John gets confused. One day he is happy. The next day he is worried. Mike stays calm because he understands what he owns. This leads to the first important lesson. Not every person in the market is an investor. Many people are speculators without even knowing it. They think they're investing, but they are actually guessing. Think about Sarah. She hears about a company from a friend. The friend says, this stock will double soon. Sarah gets excited and buys it. She does not check anything. She just hopes. This is speculation. Even if she makes money, it is still speculation because there was no real thinking behind it. Now think about Emma. She wants to invest. She reads about the company. She understands how it makes money. She checks if the price is fair. She knows there is always some risk, but she makes a careful decision. That is investing. The second lesson is very simple, but very powerful. Investing is not about excitement. It is about safety and steady thinking. When people think about investing, they often imagine fast money. But this chapter tells us something different. Real investing is actually kind of boring. It is slow, calm, and careful. Mike does not check prices every hour. He does not panic when prices fall a little. He understands that prices can move up and down, but the real value of a good company does not change quickly. John, however, checks prices all the time. His mood goes up and down with the market. This is the difference between a calm thinker and an emotional guesser. Another important idea in this chapter is about risk. Many people think risk means prices going down, but that is not fully true. Real risk is losing money because you did not understand what you were doing. Let's make this simple. If Mike buys a strong company after studying it well, even if the price goes down for a while, he is not too worried. He knows why he bought it. But if John buys a random stock and it goes down, he feels lost. He does not know what to do. That is real risk. So the third lesson is this. Risk comes from not knowing what you're doing. Think about driving a car. If you learn properly, understand the rules, and stay alert, driving is not too risky. But if you jump into a car without learning and just press the accelerator, that is very risky. Investing works the same way. Now, let's look at a small journey. At the beginning, John sees the market as a place to make quick money. He feels excited and confident. But soon, he starts facing problems. Prices fall, news changes, and he feels confused. He starts making emotional decisions. Sometimes he sells in fear. Sometimes he buys in excitement. Slowly, he loses money or makes very little. Mike starts differently. He is not trying to get rich fast. He wants to grow his money safely over time. He learns the difference between investing and speculating. He accepts that he will not catch every big jump, but he also avoids big mistakes. Over time, his money grows steadily. This chapter is trying to teach a very grounded way of thinking. It is not saying that making money is bad. It is saying that how you try to make money matters. If you treat the market like a game, you may win sometimes, but you will also lose badly at times. If you treat it like a business decision, you may not win fast, but you build something strong over time. Another simple example can help. Imagine two kids playing a game. One kid rolls a dice and hopes for a lucky number. The other kid plays a strategy game where he thinks before every move. The first kid depends on luck. The second kid depends on thinking. Investing is like the second game. One more thing this chapter makes clear is that you should be honest with yourself. If you are speculating, at least know that you are doing it. Do not fool yourself by calling it investing. This honesty helps you control your risk. For example, if John knows he is speculating, he might use only a small part of his money for it. He will not risk everything. But if he believes he is investing while actually guessing, he might take big risks without realizing it. Mike understands this clearly. He keeps his main money in careful investments. If he ever wants to try something risky, he treats it as a small experiment, not as a serious plan. As the story comes to an end, the difference between John and Mike becomes very clear. John keeps chasing fast gains and gets tired, confused, and stressed. Mike stays simple, calm, and logical. He does not try to be the smartest person in the room. He just tries to avoid big mistakes. The final message of this chapter is very practical. Investing is not about being lucky. It is about being careful. It is about understanding what you are doing and protecting your money first. If you remember just one thing, let it be this. Before you put your money anywhere, ask yourself, am I thinking or am I guessing? That one question can save you from many problems. In the end, success in investing is not about speed. It is about clarity, not about excitement, but about control, and not about following others, but about understanding your own decisions. Imagine this. John works very hard every day. He saves some money every month. One day he thinks, if I invest this money, it will grow fast. So he buys some stocks because his friend says they are hot. For a few weeks, the price goes up. John feels smart. But suddenly, the price drops. He gets scared and sells everything. Now, he has less money than before. He feels confused. He asks himself, why did this happen? I thought investing was easy. This is where the ideas from The Intelligent Investor by Benjamin Graham come in. In Chapter 3, The book explains something very important. It talks about how the market moves up and down, and why these changes should not control your decisions. It teaches you how to stay calm and think clearly, even when everything around you feels uncertain. The main idea of this chapter is simple. The market is not always logical. Prices go up and down all the time, but that does not mean the real value of a company changes so quickly. Many people treat the market like a guide, but Graham says the market is more like a moody partner. Some days it is excited and offers high prices. Other days it is scared and offers low prices. Your job is not to follow its mood. Your job is to use its mood to your advantage. Let's understand this in a very simple way. Imagine Sarah owns a small shop with her friend Mike. Every day, Mike comes to her and says, "I want to buy your share of the shop," or "I want to sell my share to you." But his price changes every day. Some days he is very happy and offers a very high price. Other days he is worried and offers a very low price. Now Sarah has two choices. She can react to Mike's mood every day, or she can stay calm and decide only when the price makes sense. The market works exactly like Mike. It keeps offering prices every day, but those prices are not always smart. Sometimes they are too high and sometimes too low. Chapter 3 teaches that smart investors do not follow the market blindly. They think for themselves. One big lesson from this chapter is about market fluctuations. That just means prices go up and down. Many people see this as a problem. They feel nervous when prices fall and excited when prices rise. But Graham says this is actually an opportunity. If you understand it correctly, these ups and downs can help you. Think about John again. When the price went up, he got excited and bought more. When the price fell, he got scared and sold. He did the opposite of what he should have done. A smart investor would do this differently. When the price is low, it may be a good time to buy. When the price is high, it may be a good time to sell or wait. Another simple example. Imagine Emma wants to buy a phone. One day the phone costs $1,000. The next day, there's a big sale and it costs $700. Emma would feel happy, right? She would think, "Great, now I could buy it cheaper." But in the stock market, people often think the opposite. When prices fall, they panic. When prices rise, they rush to buy. Chapter 3 explains that this thinking is not logical. The second important lesson is about behavior. The biggest problem in investing is not the market. It is the investor's own mind. People react emotionally. They feel fear and greed. When they see others making money, they want to join quickly. When they see losses, they want to run away. This leads to bad decisions. Graham wants you to act differently. He wants you to be calm and patient. Instead of reacting quickly, you should think slowly. Ask yourself simple questions. Is this company really worth this price? Has anything important changed? Or is it just a market mood? If the answer is that nothing has changed, then the price drop may be an opportunity, not a danger. Let's go back to Sarah and Mike. If Mike suddenly offers a very low price because he is scared, Sarah does not panic. She thinks, the shop is still the same. Nothing has changed. Why should I sell for less? In fact, she might decide to buy Mike's share because it is cheaper. That is smart thinking. The third lesson is about discipline. Investing is not about guessing the future. It is about following simple rules and sticking to them. Many people try to predict what will happen next. They watch news, listen to tips, and try to act fast. But Chapter 3 shows that this approach is risky. Instead, you should focus on what you can control. You can control your decisions. You can control your patience. You can control how you react to market changes. If you stay disciplined, you avoid big mistakes. Let's see how John can improve his journey. At first, he was confused. He followed others and reacted emotionally. But now he learned from these ideas. He understands that the market is not always right. He stops checking prices every hour. He studies the companies he invests in. He decides to buy only when the price is reasonable. And when prices fall, he does not panic. He sees it as a chance. Slowly, John's thinking changes. He is no longer controlled by fear or excitement. He becomes calm. His decisions become better. Over time, his money grows, not because he was lucky, but because he was logical. This chapter is not telling you to ignore the market completely. It is telling you to use the market wisely. The market gives you choices every day. You can accept or ignore those choices. You are not forced to act. That is your power. A very simple way to remember this is to think of the market as a shop. Every day, the shop shows you prices. Some days the prices are too high. Some days they're low. You do not have to buy every day. You wait for the right price. That is how a smart buyer behaves. And that is how a smart investor should behave. Another thing to understand is that short-term changes do not matter much. Prices may move a lot in a short time, but real value changes slowly. If you focus only on short-term movement, you will feel stressed and confused. But if you focus on long-term value, you will feel more confident. For example, if Emma buys a good phone, she does not worry about its resale price every day. She uses it and gets value from it. In the same way, when you invest in a good company, you should think about its long-term value, not daily price changes. So the problem is clear. Most people treat the market like a boss. They follow its mood. They feel happy when prices rise and sad when prices fall. This leads to poor decisions. The understanding is also clear. The market is just a tool. It gives you options, not orders. The solution is simple. Stay calm, think logically, and act only when it makes sense. In the end, Chapter 3 gives a very powerful message. The market will always move up and down. That will never change. What can change is how you react. If you react with fear and excitement, you will struggle. If you react with logic and patience, you will improve. So remember John. At first, he was confused and emotional, but after understanding these ideas, he became calm and thoughtful. That is the real goal, not just making money, but making better decisions. The simple learning is this. Do not let the market control you. Use it wisely. When prices are low, think carefully. When prices are high, stay careful. And most importantly, trust your reasoning more than the crowd. That is what makes an intelligent investor. Imagine this. Two friends, John and Mike, both decide to invest their money. John gets excited when prices go up and scared when they fall. He keeps buying and selling quickly. Mike stays calm. He thinks before he acts. Years later, John is confused and tired, while Mike has slowly built real wealth. The difference is not luck. The difference is how they think. This idea is at the heart of the book, The Intelligent Investor, by Benjamin Graham. In Chapter 4, the focus is very simple but powerful. It talks about how the whole market moves up and down, and why a smart investor should not get carried away by these movements. It explains that prices change all the time, but your thinking should stay steady. The main idea is this. The market is like a person with changing moods. Some days it feels very happy and offers high prices. Some days it feels very sad and offers low prices. But just because the market feels something, it does not mean you should feel the same. A smart investor does not follow the crowd. They stay calm and think clearly. Let's understand this in a simple way. Imagine Sarah owns a small shop. One day, someone offers to buy her shop for a very high price. The next day, another person offers a very low price. The shop itself did not change. Only the offers changed. If Sarah gets excited by the high offer and scared by the low one, she will make bad decisions. But if she understands the real value of her shop, she can ignore these mood swings and act wisely. This is exactly how the stock market works. Prices keep changing, but the real value of a company does not change every minute. Chapter 4 teaches that you should not react to every small change in price. Instead, you should focus on understanding the value and stay patient. One important lesson from this chapter is about market fluctuations. This simply means prices going up and down. Many people think these changes are dangerous, but the book explains something interesting. These ups and downs are not your enemy. They can actually help you if you use them wisely. Think about John again. When prices go up, he feels he is missing out, so he buys a high price. When prices fall, he feels scared, so he sells at a low price. This is the worst possible pattern. Buy high and sell low. That leads to losses. Now look at Mike. When prices fall, he does not panic. He sees it as a chance to buy good things at a lower price. When prices rise too much, he becomes careful. He does not chase the price. Over time, this simple thinking helps him grow his money. So the lesson is very clear. Do not follow your emotions. Use price changes to your advantage instead of letting them control you. Another important idea is about having a plan. Chapter 4 shows that without a plan, you will act randomly. And random actions usually lead to bad results. A plan gives you control. Let's say Emma decides she will invest a fixed amount of money every month, no matter what the market is doing. If prices are high, she buys fewer shares. If prices are low, she buys more shares. Over time, this helps her get a fair average price. She does not need to guess the perfect moment. She simply follows her plan. This idea is very powerful because it removes stress. Many people try to guess when the market will go up or down, but that is very hard. Even experts get it wrong. Chapter 4 suggests a simple way. Do not try to predict the market. Just stay consistent and patient. Another lesson is about thinking long-term. Many people focus only on short-term changes. They check prices every day. They worry about small movements. But real investing is not about days or weeks. It is about years. Imagine planting a tree. If you keep digging it up every week to check its growth, it will never grow properly. You need to give it time. Investing works the same way. If you keep reacting to every small change, you will not see real growth. Mike understands this. He invests and then gives it time. He does not panic when prices fall for a short time. He knows that over a long period, good investments tend to grow. This patience is what makes him successful. There's also a very simple but important idea about control. You cannot control the market. You cannot control prices, but you can control your actions. You can control your decisions. And that is enough. John tries to control everything. He watches the market all day. He reacts to every news. He feels stressed and confused. Mike focuses only on what he can control. He decides when to buy, how much to invest, and when to stay quiet. This makes his journey simple and peaceful. Chapter 4 also shows that being smart is not about knowing everything. It is about avoiding big mistakes. Many people think they need to be very clever to invest. But the truth is, you just need to stay calm and avoid emotional decisions. For example, when everyone is excited and buying quickly, that is usually a risky time. Prices may already be too high. And when everyone is scared and selling, that might be a good time to look for opportunities. But this requires calm thinking. It is not easy, but it is simple. Let's look at a small journey to understand this better. At the beginning, John is excited. He sees others making money and jumps in without thinking. Soon prices fall. He gets scared and sells. He loses money and feels confused. Over time, he realizes his mistake. He learns to slow down. He starts making decisions based on logic instead of emotions. Slowly, his results improve. This journey shows that mistakes are part of learning. But the key is to learn the right lesson. The right lesson is not to avoid the market. It is to change how you think about it. In simple words, Chapter 4 teaches you to treat the market like a tool, not a boss. The market gives you options. It shows prices, but it should not control your decisions. You are in charge, not the market. So what is the final message here? Stay calm. Think clearly. Do not follow the crowd. Use price changes wisely. Have a simple plan and stick to it. Focus on long-term growth instead of short-term noise. If you remember just one thing, remember this. The biggest danger in investing is not the market. It is your own reaction to it. When you learn to control that, everything becomes easier. That is a quiet power behind Chapter 4 of The Intelligent Investor. It does not promise quick success. It teaches steady thinking. And in the long run, steady thinking is what builds real wealth. Imagine you work hard, save some money, and finally decide to invest it. You feel excited. You think, now my money will grow fast. But after a few months, the market goes up and down. Some days you feel smart, and other days you feel worried. You start guessing, reacting, and maybe even making mistakes. This is exactly where most people go wrong. Let's look at a simple story. John is a regular person. He saves a small amount every month. One day, he hears that bonds are safe. so he puts all his money into them. Later, he hears that stocks are giving better returns, so he quickly switches. When prices fall, he gets scared and sells. When prices rise, he feels greedy and buys again. After some time, John notices something strange. Even though he is always active, his money is not growing well. In fact, sometimes he loses money. He feels confused. This is where the ideas from The Intelligent Investor by Benjamin Graham help us understand what John is doing wrong, especially in Chapter 5. This chapter talks about something very simple but very powerful: how to choose between stocks and bonds, and how to balance them in a smart way. The main idea is not about finding the best investment. It is about creating a balance that protects you and helps you grow over time. Instead of trying to be perfect, you try to be stable. Think of your money like a team. You don't want all your players doing the same job. Some should be strong and safe, and some should be active and growing. Bonds are like the safe players. They usually give steady but smaller returns. Stocks are like the active players. They can grow faster, but they also go up and down. John's mistake was simple. He kept jumping from one side to the other. First all bonds, then all stocks, then back again. He was reacting to the market instead of following a plan. The book teaches a better way. Instead of guessing, you should decide a fixed balance between stocks and bonds. For example, you might choose to keep 50% in stocks and 50% in bonds. This way, you're never fully exposed to risk, and you are never missing growth either. Now, let's understand why this works in a very simple way. Imagine Sarah has $100. She puts $50 in stocks and $50 in bonds. After some time, stocks grow and become $70, while bonds stay at $50. Now her total is $120, but her balance is broken. Stocks are now a bigger part. What should Sarah do? Most people think, stocks are doing well, so keep more in stocks. But the book suggests something different. Sarah should sell some stocks and move back to her original balance. She might sell $10 of stocks and put into bonds again. This may feel strange. Why sell something that is going up? But this is the smart part. She is not chasing the market. She is controlling her risk. Now imagine the opposite. Stocks fall and become $30, while bonds are still $50. Now Sarah has $80. Many people panic and sell stocks. But the book suggests she should do the opposite. She should buy more stocks to return to balance. This is called disciplined investing. You are not reacting emotionally. You are following a simple plan. Let's go back to John. At first, he was confused because he had no clear rule. He followed news, opinions, and feelings. But once he understood this idea, he made a simple plan. He decided to keep a steady mix of stocks and bonds. Every few months, he checked his balance and adjusted it. At first, it felt boring. He was not making exciting moves. But slowly, something changed. His stress went down. He stopped worrying about daily changes. His money started growing more steadily. He was no longer chasing quick gains. He was building long-term growth. One important lesson here is that no one can predict the market perfectly. Prices go up and down for many reasons. Trying to guess the right time is like trying to guess the weather months in advance. Sometimes you might be right, but most of the time you will be wrong. Instead of guessing, the book teaches you to prepare. By keeping a balance, you are ready for both good and bad times. When the market is high, your bonds protect you. When the market is low, your stocks give you a chance to grow later. Another important lesson is that your plan should match your comfort level. Some people are okay with more risk. They might keep more money in stocks. Others prefer safety. They might keep more in bonds. There is no one perfect answer. The key is to choose a mix you can stick with, even when things get tough. Let's take another simple example. Mike and Emma both invest $100. Mike puts everything in stocks because he wants fast growth. Emma splits her money between stocks and bonds. After a year, the market drops. Mike's money falls to $70. He gets scared and sells everything. Emma's money drops too, but only to $85 because her bonds stay stable. She feels calm and keeps her plan. Later, the market recovers. Stocks go up again. Mike is still scared and waits too long to come back. Emma's stocks grow again and her total value increases. Over time, Emma does better, not because she is smarter, but because she stayed balanced and calm. This shows something very important. Success in investing is not about being the smartest person. It is about being the most consistent and disciplined. Chapter 5 is not teaching you a trick to get rich quickly. It is teaching you a system to avoid big mistakes. Most people lose money not because the market is bad, but because their decisions are emotional and unplanned. The simple solution is to create rules for yourself before things get emotional. Decide your balance. Decide when you will adjust it. Then follow it, no matter what the market is doing. Think of it like driving a car. If you keep turning the steering wheel randomly, you will crash. But if you follow the road and make small adjustments, you will reach your destination safely. John's journey is a good example. At first, he was lost, reacting to every change. Then he learned to create a balance and follow it. He stopped trying to be perfect. He focused on being steady. Over time, he noticed something powerful. His money was not growing in big jumps, but it was growing steadily. More importantly, he felt in control. He was no longer afraid of market changes. The final message is very simple. You don't need to predict the future. You don't need to chase the best investment. You just need a clear plan and the discipline to follow it. Balance your money between safety and growth. Adjust it from time to time. Stay calm when things go up or down. This simple approach can protect you from big mistakes and help your money grow over time. In the end, investing is not a game of speed. It is a game of patience and control. And the people who win are not the ones who move the fastest, but the ones who stay steady the longest. Imagine this. John works hard every day. He saves some money every month. One day, he hears his friend Mike say, "Hey, I found a stock that will grow fast. You can double your money quickly." John feels excited. He thinks this is his chance to get rich fast. But he also feels a little unsure. He does not want to lose his hard-earned money. So now he has a problem. Should he follow Mike and take the risk, or should he be careful? This is where the book The Intelligent Investor by Benjamin Graham helps. In Chapter 6, the author talks about how a smart and active investor should think. But instead of telling what to do, this chapter mainly teaches what not to do. This is very important, because many people lose money not because they don't know what to do, but because they make bad choices. The main idea of this chapter is simple. If you want to be a smart investor, first learn to avoid bad investments. Think of it like driving a car. You don't just learn how to go forward. You also learn how to avoid accidents. In investing, avoiding mistakes is often more important than finding the perfect opportunity. Let's go back to John. He wants to grow his money faster than a normal saver. This means he is an enterprising investor. That sounds smart, but it also means he must be more careful. He cannot just follow tips or rumors. He needs to think clearly and avoid dangerous options. The first big lesson is this. Stay away from low-quality bonds and risky loans. Imagine Sarah lends money to someone who has no stable job and no clear way to pay her back. That is risky, right? In the same way, some companies or organizations offer bonds with high interest. They promise more money, but often they are not strong enough to pay back. People see the high return and get excited, but they forget the risk. Graham explains that high return often comes with high risk. If something is offering much more money than normal, you should ask why. It is like someone offering you a phone at a very low price. You should think, is something wrong with it? In investing, this thinking is very important. A smart investor does not chase high returns blindly. They first check safety. Now, let's look at the second lesson. Avoid buying stocks just because they are popular or rising fast. Mike tells John about a stock that is going up every day. Many people are buying it. It feels like everyone is making money. John feels pressure. He thinks, if I don't buy now, I will miss out. But this is exactly the trap. When a stock is already very popular, its price is often too high. People are not buying based on real value. They are buying because others are buying. This is like a crowd running in one direction without knowing why. Graham teaches that a smart investor should not follow the crowd. Instead, they should think calmly. Ask simple questions. Is this company really strong? Is the price fair, or is it just hype? If the price is too high, even a good company can be a bad investment. Let's make it simple. Imagine a bottle of water. Normally, it costs $1, but during a big event, people start selling it for $5. The water is the same, only the price changed. Would you buy it at $5? Probably not. In the same way, a stock can become too expensive. The third lesson is about new companies and new offers. Sometimes, companies launch their shares for the first time. This is called an IPO. These are often advertised heavily. People get excited because it feels new and special. But Graham warns against this excitement. New offerings are often priced high because sellers want to make maximum profit. Buyers do not have enough history to understand the company. It is like buying a product without any reviews. You don't know if it is good or bad. Let's say Emma sees a brand new phone launched today. It looks great in ads, but there are no reviews, no real tests. If she buys it immediately, she is taking a risk. It might be great, or it might have problems. A smart person waits, watches, and then decides. In investing, patience is a big strength. You do not need to rush. Opportunities will always come again. But if you lose money, it is hard to recover. Now let's connect all this to John's journey. At first, he feels confused. He hears different advice from different people. Some say take risks. Some say play safe. He does not know what to do. Then he learns a simple idea. Before trying to make money, avoid losing money. This changes his thinking. Now, when Mike suggests a hot stock, John does not jump in. He asks questions. Is the company strong? Is the price fair? Is this just hype? When he sees a bond with very high interest, he does not get excited. He asks, why is the return so high? Is it risky? When he sees a new company offering shares, he decides to wait and watch. Slowly, his thinking becomes clearer. He stops chasing quick profits. He starts focusing on safety and value. This does not mean he never takes risks. It means he takes smart risks. One important thing Graham teaches is that being active does not mean being careless. An enterprising investor is not someone who jumps into everything. It is someone who studies, thinks, and chooses carefully. Let's take a simple real-life example. Imagine you want to buy a used car. You have two options. One car is cheap, but has many unknown issues. The other car is slightly more expensive, but well-maintained and tested. Which one is safer? A careless buyer may choose the cheap one, thinking they are saving money, but later, they may spend more on repairs. A smart buyer looks at the full picture. They think long-term. Investing works the same way. Cheap does not always mean good. Expensive does not always mean bad. What matters is value and safety. Another small idea in this chapter is about being disciplined. Many people know what is right, but they still make mistakes because of emotions. Fear and greed are powerful. When prices go up, people feel greedy. When prices go down, people feel scared. Graham's advice is to stay calm. Do not let emotions control your decisions. Think like a business owner, not like a gambler. A business owner looks at facts, numbers, and long-term value. A gambler looks for quick wins. John slowly learns this difference. Earlier, he used to check stock prices every hour. He felt happy when prices went up and worried when they went down. Now, he focuses on understanding the business behind the stock. He thinks long-term. This gives him peace of mind. He is no longer stressed by daily changes. He knows he has chosen carefully. In the end, the message of this chapter is very clear and powerful. You don't need to be perfect to succeed in investing. You just need to avoid big mistakes. Stay away from risky promises. Don't follow the crowd blindly. Be careful with new and unknown opportunities. Think before you act. If you do this, you already have a strong advantage, because most people lose money by making simple mistakes again and again. So next time you hear about a quick profit or a sure win, pause for a moment. Ask simple questions. Think logically. And remember John's journey. He did not become successful by chasing every opportunity. He became successful by choosing wisely and avoiding danger. That is what makes an intelligent investor. Imagine this. You work hard, save money every month, and finally decide to invest. At first, Things go well. Your money grows. You feel smart. Then suddenly, the market drops. Prices fall. Fear starts to grow inside you. You wonder, should I sell everything before I lose more? Or should I wait? This is the moment where most people make their biggest mistake. Let's understand this with a simple story. John is a regular guy. He saves money and puts it into the stock market. In the beginning, prices go up and he feels like a genius. He checks his phone every day and feels happy. But one day, the market starts falling. His investment goes down by 10%, then 20%. John gets scared. He thinks he is losing everything. So he sells all his stocks to save his money. A few months later, the market goes back up. The same stocks he sold are now much higher. John feels regret. He lost money not because the market was bad, but because his reaction was wrong. This is exactly what Chapter 7 of _The Intelligent Investor talks about. It focuses on how investors behave when the market goes up and down. The main idea is simple but powerful. The market will always move. Sometimes it will go up, sometimes it will go down. But your success depends on how you react to these changes, not on the changes themselves. Benjamin Graham explains that many people treat investing like a game of guessing. They try to predict when the market will rise or fall. But this is very hard, almost impossible, even for experts. Instead of trying to predict the future, he says you should focus on controlling your actions. Let's break this down in a very simple way. Think of the market like the weather. Some days are sunny. Some days are rainy. You cannot control the weather, but you can control what you wear. If it rains, you carry an umbrella. If it is hot, you wear light clothes. In the same way, you cannot control the market, but you can control your decisions. One important lesson from this chapter is about being defensive and aggressive at the right time. This does not mean fighting the market. It means adjusting your strategy based on conditions. Let's take Sarah as an example. Sarah invests her money in two main things. One part goes into safe investments, like bonds. The other part goes into stocks, which can grow faster, but also go up and down more. When the market becomes very expensive and risky, Sarah puts more money into safe options. When the market becomes cheap and people are scared, she slowly puts more money into stocks. This is like balancing your weight. If you lean too much on one side, you can fall. So you adjust your position to stay stable. Another key lesson is about not following the crowd. Most people feel safe when they do what everyone else is doing. But in investing, this can be dangerous. When everyone is excited and buying, prices are usually high. When everyone is scared and selling, prices are usually low. Let's go back to John. When the market was going up, everyone around him was talking about stocks. His friends were making money. Social media was full of success stories. So John felt confident and kept buying more. But this was a time when prices were already high. Later, when the market crashed, everyone started panicking. News was full of fear. So John sold everything. He bought high and sold low. This is the opposite of what a smart investor should do. Benjamin Graham teaches that a smart investor should do the reverse. When prices are high and risky, be careful. When prices are low and people are afraid, look for opportunities. Now, this does not mean you should jump in blindly when prices fall. It means you should think calmly and look at value. Ask yourself, is this a good company? Is this a good investment at this price? If the answer is yes, then a lower price can actually be a good thing. Another important idea in this chapter is about having a plan. Most people invest without a clear plan. They just react to what is happening. But reacting without a plan leads to mistakes. Let's imagine Mike. Mike decides before investing that he will keep 50% of his money in stocks and 50% in safe investments. Every year, he checks his balance. If stocks grow too much and become 70%, he sells some and moves it back to 50%. If stocks fall and become 30%, he buys more to bring it back to 50%. This simple rule keeps Mike disciplined. He does not get too excited when prices rise. He does not get too scared when prices fall. He just follows his plan. This idea is very powerful because it removes emotion from decisions. Most mistakes in investing come from emotions like fear and greed. When prices go up, greed makes you buy more. When prices go down, fear makes you sell. A plan protects you from these emotions. Now let's look at a small journey to understand everything together. Emma starts investing without much knowledge. She watches the market every day. When prices go up, she feels happy and buys more. When prices fall, she feels scared and sells. After some time, she notices that her money is not growing much. In fact, she is losing money. One day, she decides to learn and understand what she is doing wrong. She realizes that she is reacting to the market instead of thinking calmly. She learns that the market will always move and she cannot control it. She also learns that she needs a simple plan. So Emma changes her approach. She divides her money between stocks and safe investments. She decides that she will not check prices every day. She will review her investments only once in a while. When prices fall, instead of panicking, she asks herself if the investment still makes sense. If it does, she holds or even buys more slowly. When prices rise too much, she becomes careful and does not get carried away. Over time, Emma becomes more stable. Her money starts growing slowly but steadily. She feels less stressed because she is not reacting to every small change. She understands that investing is not about quick wins. It is about making smart decisions over a long time. This is the heart of Chapter 7. It teaches you how to behave in a world where prices keep changing. It tells you that success does not come from predicting the market. It comes from staying calm, having a plan, and thinking clearly. One more simple idea to remember is this: price and value are not the same. Just because a price is going up does not mean something is more valuable. And just because a price is going down does not mean something is worthless. The market often acts based on emotions, not logic. Your job is to stay logical. Think of it like a shop. If your favorite item suddenly goes on sale, you feel happy and buy more. But in the stock market, people do the opposite. When prices go down, they get scared and stop buying. A smart investor thinks like a calm shopper, not like a panic crowd. In the end, the message is very clear. The market will always test your patience. It will try to make you feel excited and scared again and again. But if you stay calm, follow a simple plan, and think logically, you can avoid most mistakes. So next time you see prices going up or down, remember John, Sarah, Mike, and Emma. Remember that your reaction matters more than the market itself. Stay steady, think clearly, and let time work in your favor. Imagine this. You buy a toy for $100. The next day, someone offers you $80. You feel bad. Another day, someone offers $120. You feel happy. But here's the question. Did the toy really change? Or did only the price change? Now think about this like a story. John is a normal guy. He saves some money and decides to invest. One day, he buys shares of a company for $50 each. After a week, the price drops to $40. John gets scared. He thinks, I made a mistake. So he sells everything. A month later, the same shares go up to $70. Now John feels regret. He lost money because he reacted too fast. This is exactly what Chapter 8 of _The Intelligent Investor_ is trying to teach. It talks about how market prices move up and down all the time, and how most people make bad decisions because they follow these price changes emotionally. The main idea is simple but very powerful. The market is there to serve you, not to guide you. You should not follow the market like a leader. You should treat it like a tool. Benjamin Graham explains this idea using something called Mr. Market. But don't worry, we'll keep it very simple. Imagine Mr. Market is a person who comes to you every day and offers to buy your investment or sell you more. But he is not stable. Some days he is happy and excited. He offers very high prices. Some days he is sad and afraid. He offers very low prices. Now, here is the important part. You do not have to listen to him every day. You can ignore him whenever you want. Let's go back to John. After losing money, he learns this lesson. Next time, when he buys shares, he decides not to panic. The price falls again, this time from 60 to 45. Mr. Market is scared. He is offering low prices. But John stops and thinks, has the company become worse? Or is this just a price change? He checks the company. It is still doing good. Nothing has changed. So instead of selling, he does nothing. He waits. After some time, the price goes back up. John stays calm and makes a profit. This is the first big lesson of Chapter 8. Price is not the same as value. Just because the price goes down does not mean the thing is bad. And just because the price goes up does not mean it is good. The real question should always be, what is a true value? Think about a simple example. Sarah buys a phone for $500. After a month, someone says the same phone is now selling for $400. Does that mean the phone became worse? No, it is still the same phone. It still works the same. The price changed, not the value. But many people mix these two things. They think price and value are the same. That is where mistakes happen. The second big lesson is about emotions. The market moves because people feel fear and greed. When prices fall, people get scared and sell. When prices rise, people get excited and buy. But this behavior creates a cycle. People buy high and sell low. This is the opposite of what they should do. Let's take Mike as an example. Mike sees a stock going up fast. From 20 to 40 to 60. Everyone around him is talking about it. So he buys at 60. Soon after, the price drops to 45. Mike gets scared and sells. He loses money. What went wrong? Mike followed the crowd. He reacted to emotion, not logic. Now compare Mike with Emma. Emma studies the company first. She decides that the company is worth around 70 per share. She waits patiently. When the price drops to 50, she buys. When the price rises to 65, she does nothing. She is not excited. She is not scared. She is focused on value. Over time, she makes steady gains. This is the difference between a smart investor and an emotional investor. A smart investor uses the market as an opportunity. An emotional investor gets controlled by the market. The third lesson is about control. You cannot control the market. You cannot decide when prices will go up or down, but you can control your decisions. You can control your reactions. Think of it like the weather. You cannot control rain or sun, but you can decide what to wear. If you panic every time it rains, you will suffer. But if you stay calm and prepared, you will be fine. The market is the same. It will go up and down, sometimes fast, sometimes slow. If you react every time, you'll get tired and make mistakes. But if you stay calm and think clearly, you will make better decisions. Let's connect everything into a small journey. At first, John was confused. He thought price meant value. When prices fell, he felt fear. When prices rose, he felt excitement. Because of this, he made quick decisions and lost money. Then he learned about Mr. Market. He understood that prices are just offers, not commands. He realized that he does not have to act every day. He can wait. He can think. After that, his behavior changed. When prices fell, he did not panic. When prices rose, he did not rush. He focused on value. He made decisions slowly and carefully. Over time, his results improved. This chapter is not teaching complex math. It is teaching simple thinking. It is about discipline. It is about patience. It is about not letting emotions control your actions. Let's make it even simpler. Imagine you own a small shop. One day, someone offers to buy your shop for a low price. Will you sell just because of that offer? No. You will think about the real worth of your shop. If the business is good, you will reject the offer. Another day, someone offers a very high price. Now you will think again. Maybe you will sell if it makes sense. The stock market is the same. You own a part of a business. Prices are just offers from Mr. Market. You should decide based on logic, not feelings. So the clear message of Chapter 8 is this. Do not let the market control you. Use it when it helps you. Ignore it when it confuses you. Focus on real value, not changing prices. Stay calm when others are scared. Stay careful when others are excited. If you can follow this simple thinking, you will avoid the biggest mistakes that most people make. And over time, that will make a huge difference in your results. Imagine this. You walk into a store and see a phone. Yesterday it was $500. Today it is $300. Tomorrow it might be $700. Would you panic? Would you rush to buy or sell? Or would you stop and think, what is this phone actually worth? Now think about the same idea, but in the world of stocks. Prices go up and down every day, and most people react without thinking. That is where many people lose money. Let's start with a simple story. Meet John. John just started investing. One day, he buys shares of a company for $100 each. A week later, the price drops to $80. John gets scared. He thinks, I am losing money. I should sell before it gets worse. So he sells. But after a few months, the price goes back up to $120. John feels frustrated. He sold at the wrong time. Now meet Sarah. She buys the same stock at $100. When the price drops to $80, she does not panic. Instead, she asks, did anything change about the company? Is it still strong? If the answer is yes, she waits. Later, when the price rises to $120, she gains profit. Same situation, different thinking, very different results. This idea comes from a powerful chapter in the book The Intelligent Investor by Benjamin Graham. Chapter 9 talks about something very important called Mr. Market. But don't worry, this is not a real person. It is just a simple way to understand how the stock market behaves. Think of Mr. Market as your business partner. Every day, he comes to you and tells you a price at which he is willing to buy your share or sell a share. But here's the problem. Mr. Market is not stable. Some days he is very happy and excited. On those days, he offers very high prices. Other days, he is sad and fearful. On those days, he offers very low prices. His mood keeps changing all the time. Now here's the key idea. You do not have to agree with Mr. Market. You do not have to act every time he shows up. You are free to ignore him. This is the main message of Chapter 9. The market gives you prices. It does not tell you the true value. Your job is to think for yourself. Let's break this down into simple lessons. The first lesson is this. The market is emotional, but you should not be. Prices go up and down because people feel fear and greed. When people feel excited, they buy more and prices go up. When people feel scared, they sell and prices go down. But feelings are not facts. Just because a price drops does not mean the company is bad. And just because a price rises does not mean the company is great. Think about a simple example. Imagine Mike owns a small bakery. His shop makes good money every day. Now imagine someone comes and says, today your bakery is worth $10,000. The next day, the same person says, actually, it is worth $7,000. The next day, now it is $12,000. Would Mike believe these numbers blindly? No, he knows his business. He knows how much it earns. He knows its real value. So he does not get emotional about these daily changes. Stocks work the same way. When you buy a stock, you are buying a piece of a business. So instead of looking only at price, you should think about the business itself. The second lesson is this. Use the market. Do not follow it. Mr. Market is there to serve you, not to guide you. This means you should take advantage of his mood swings. When he is very negative and prices are low, it might be a good time to buy. When he is overly excited and prices are too high, it might be a good time to sell. Let's go back to Sarah. When the stock price dropped from $100 to $80, she did not panic. Instead, she thought, the business is still strong. The price is just lower. So she saw it as an opportunity. It is like buying something on sale. If you wanted a shoe and it suddenly became cheaper, you would be happy, not scared. But in the stock market, people do the opposite. They get scared when prices fall. Now think about Emma. She sees a stock going up every day. From $100 to $150 to $200. She feels excited. She thinks, everyone is buying, I should buy too. So she buys at $200. But soon after, the price drops to $150. Emma loses money. Why? Because she followed the crowd instead of thinking for herself. This is exactly what Chapter 9 warns us about. Do not let the market control your decisions. The third lesson is this. Know the difference between price and value. Price is what you pay. Value is what you get. These two are not always the same. Imagine you see a bottle of water. Normally, it costs $1. But today, someone is selling it for $5. Would you buy it? Probably not, because you know its real value. Now imagine the same bottle is selling for 50 cents. That is a good deal. You might buy more. In the stock market, this idea is very important. Sometimes a good company is selling at a low price. That is a good opportunity. Sometimes a weak company is selling at a high price. That is risky. Let's follow a small journey to understand this better. John started investing without understanding these ideas. He focused only on price changes. When prices dropped, he panicked and sold. When prices rose, he rushed to buy. Over time, he kept losing money. Then he learned about Mr. Market. He realized that the market is not always right. He started studying the companies he invested in. He asked simple questions. Is this company making money? Is it growing? Is it strong? Now, when prices dropped, he did not panic. He checked the facts. If the company was still good, he stayed calm or even bought more. Slowly, his results improved. This is a shift from being emotional to being logical. Another simple way to understand this is to think like a shop owner. If you own a shop, you do not check its price every day and decide to sell it based on daily changes. You focus on running the business well. You care about long-term growth. Investing should be the same. One more example. Imagine Sarah owns a small part of a company. Every day, someone offers her a different price for her share. Some days the offer is low. Some days it is high. If she accepts every offer without thinking, she will make poor decisions. But if she knows the real value of her share, she will only act when the price makes sense. This is what smart investors do. They do not react to every movement. They wait for the right moment. Now, let's make it even simpler. The market is like a noisy person who keeps shouting prices at you. Sometimes he shouts high numbers, sometimes low numbers. Your job is not to listen to the noise. Your job is to stay calm and think clearly. So what is the final message of this chapter? Do not let the market control your mind. Use it as a tool. Focus on value, not just price. Stay calm when others are scared. Stay careful when others are too excited. If you remember just one thing, remember this. The market is there to serve you, not to guide you. You do not have to follow every move. You just have to make smart decisions based on logic and understanding. And that is how you become an intelligent investor. Imagine this. You walk into a store and see your favorite shoes. Yesterday, they were priced at $100. Today, the price suddenly drops to $60. Tomorrow, it might go back to $120. Now tell me, did the value of the shoes really change so fast? Or is it just the price that is jumping around? This simple idea is exactly what this chapter is about. Let's start with a short story. John buys a small piece of a company, which we call a stock. He buys it for $50. The next day, he checks the price, and it drops to $40. John gets scared. He thinks he made a mistake, so he sells it. A week later, the price goes up to $70. Now John feels bad. He thinks he lost a great chance. Later, he buys another stock at $80 because everyone says it will go higher. But this time it falls to $50 and he loses money again. John feels confused. He keeps asking, why is this happening to me? This is where the book, The Intelligent Investor, helps. In Chapter 10, the author explains something very important. The market, which means all buyers and sellers, does not behave in a calm and logical way all the time. Sometimes it acts like a very emotional person. It gets excited, scared, greedy, and confused. And because of that, prices go up and down in a crazy way. The main idea of this chapter is simple. Prices move because of emotions, not always because of real value. And if you understand this, you can make better decisions. Think of the market like a person named Mike. One day, Mike is very happy. He thinks everything is great, so he offers you a high price for your stock. The next day, Mike is very sad. He thinks everything is bad, so he offers you a very low price for the same stock. Now here's the key question. Should you follow Mike's mood, or should you think for yourself? The smart answer is to think for yourself. This is the heart of the chapter. Let's break this down into simple lessons. The first lesson is that price is not the same as value. Just because something is expensive does not mean it is good. And just because something is cheap does not mean it is bad. For example, Sarah sees a phone selling for $1,000. She thinks it must be amazing because it is expensive, but when she uses it, she finds it is not very useful. At the same time, she sees another phone for $500. It works better and lasts longer, so the cheaper one actually has more value. In the stock market, the same thing happens. A stock can be overpriced or underpriced. The market price changes every day, but the real value of a company changes slowly. A good business does not become bad in one day, and a bad business does not become great in one day. But prices move fast because people react fast. The second lesson is about emotions. Most people buy and sell based on feelings. When prices go up, they feel excited. They think, I should buy now before it gets even higher. When prices go down, they feel scared. They think, I should sell now before I lose everything. This behavior creates a cycle. People buy high and sell low, which leads to losses. Let's go back to John. His problem was not the market. His problem was his reaction. When the price dropped, he felt fear. When the price went up, he felt regret. Because of this, he made poor decisions. If John had stayed calm and focused on the real value, he would have done better. Now imagine another person, Emma. Emma also buys a stock at $50. The price drops to $40. But instead of panicking, Emma asks a simple question. Has the company become worse? Or is this just the market being emotional? She studies the company. She sees that the business is still strong. So she decides to hold her stock. Later, the price rises to $70. Emma benefits because she stayed calm and logical. This brings us to the third lesson. The market is there to serve you, not to guide you. This is a very powerful idea. Most people think the market tells them what to do. But the truth is, the market only gives you prices. It is like a shop that changes prices every day. You are free to buy, sell, or do nothing. Think about a grocery store. If the price of apples drops, you may buy more. If the price goes up, you may buy less. But you don't panic. You don't feel emotional. You simply make a smart choice. The stock market should be treated the same way. Now let's connect everything into a small journey. At the start, John was confused and emotional. He followed the market's mood. When the market was happy, he bought. When the market was scared, he sold. This caused him to lose money and feel frustrated. Then John learns the ideas from this chapter. He understands that the market is not always logical. He learns that price and value are different. He realizes that his emotions were the real problem. Finally, John changes his approach. He stops checking prices every minute. He studies companies instead of following trends. When prices fall, he does not panic. When prices rise, he does not get greedy. He starts thinking like Emma. Over time, his decisions improve and his results become better. This chapter is not teaching you how to predict the future. It is teaching you how to behave. And behavior is more important than prediction. You don't need to know what the market will do tomorrow. You just need to stay calm and think clearly. In real life, this idea is useful in many situations. For example, when people around you are excited about something, you may feel pressure to join. But if you stop and think, you may see that it is not a good decision. Or when everyone is worried, you may feel scared. But sometimes that is the best time to act. The key is to separate feelings from facts. Feelings change quickly. Facts change slowly. Smart decisions come from facts, not feelings. So what is the final message of this chapter? The market will always move up and down. It will act emotional and unpredictable, but you don't have to follow it. You can stay calm, think clearly, and make your own decisions based on value. If you do this, you become an intelligent investor. At the end of the day, success in investing is not about being the smartest person. It is about being the most disciplined. It is about not letting fear or excitement control you. It is about understanding that price is just a number, but value is what truly matters. So next time you see a price going up or down, remember this simple idea. Don't ask, what is the market doing? Instead, ask, what is the real value here? That one question can change the way you think, and it can help you make better decisions for a long time. Imagine you are buying a used phone from someone. The seller says, this phone is worth $10,000, but you are not fully sure. Maybe the battery is weak. Maybe something is hidden. So what do? You say, I will only buy it for $6,000. Why? Because you want some safety in case things go wrong. That extra gap is your protection. That simple idea is the heart of Chapter 11 from _the Intelligent Investor _. Let's start with a small story. John wants to invest his money. He hears about a company that everyone says is amazing. People say will grow fast and make huge profits. The stock price is already very high. John feels excited. He thinks, if I don't buy now, I will miss the chance. So he buys the stock at a high price. A few months later, the company does not perform as expected. The price falls. John loses money. He feels confused and asks, what did I do wrong? Now let's look at Sarah. She also wants to invest. She studies the same company. She tries to understand what the company is really worth based on its earnings and business strength. She calculates that the company is worth around $100 per share, but the market price is $95. She thinks, this is too close. If I am wrong even a little, I could lose money. So she waits. Later, the price falls to $70. Now she buys. Even if her calculation is slightly wrong, she still has a safety cushion. That is the difference. Chapter 11 talks about one powerful idea called the margin of safety. This idea is very simple. It means you should always buy something for less than what it is worth. That difference between price and value is your protection. Just like John should have paid less for a phone to stay safe, an investor should also pay less for a stock to stay safe. The main idea of this chapter is not about predicting the future. It is about protecting yourself from mistakes. Because in real life, we all make mistakes. We may think a company will grow, but it may not. We may think earnings will increase, but they may fall. So instead of trying to be perfect, the smart approach is to build a safety cushion. Think about it like crossing a bridge. If a bridge can hold 10,000 kilograms and your truck weighs 9,900 kilograms, would you feel safe? Probably not. But if your truck weighs only 5,000 kilograms, now you feel relaxed. Even if something goes slightly wrong, the bridge will still hold. That extra strength is your margin of safety. Now, let's break down the first important lesson. The future is always uncertain. No one can predict exactly what will happen. Even experts can be wrong. So instead of trying to guess perfectly, you should assume that you might be wrong. And then you protect yourself. This is not fear. This is smart thinking. Sarah did not try to guess the perfect future. She simply made sure she was buying at a safe price. The second lesson is about price and value. Many people think a good company is always a good investment, but that is not true. A company may be strong, but if its price is too high, it becomes risky. Imagine buying a simple pen for $1,000. Even if the pen is good, the price is too high. You will likely lose money if you try to sell it later. In the same way, a great company can become a bad investment if you pay too much for it. Now think about Mike. He sees a popular company that everyone is talking about. The price has already gone up a lot. He feels excited and buys it, but he does not think about value. He only thinks about popularity. After some time, the excitement fades. The price drops. Mike realizes that he paid too much. If he had waited and bought at a lower price, he would have been safer. The third lesson is about thinking like a business owner, not a gambler. When you buy a stock, you are not just buying a number on a screen. You are buying a part of a real business. So you should ask simple questions. Is this business making money? Is it stable? What is it really worth? And most importantly, am I buying at a safe price? Let's make this even simpler. Suppose a small shop earns $10,000 every year. If someone asks you to buy that shop for $50,000, it might be a good deal. But if they ask for $500,000, it becomes risky. The shop is the same, only the price changes. This is exactly how stocks work. Now, let's look at the journey of understanding. At first, people like John and Mike focus on excitement. They hear stories, follow trends, and act quickly. They think investing is about finding the next big thing. But after losing money, they start asking questions. Why did I lose? What did I miss? Slowly, they learn that the problem was not the company, but the price they paid. Then comes the understanding. They realize that investing is not about being right all the time. It is about staying safe even when they're wrong. This changes their mindset. They stop chasing fast gains. They start looking for safe opportunities. Finally, they find the solution. They only buy when the price is clearly lower than the value. They wait patiently. Sometimes they do nothing for a long time, but when they act with confidence because they have a safety margin. This idea also helps in reducing stress. When you buy something at a high price, you keep worrying. You keep checking the price again and again. But when you buy with a margin of safety, you feel calm. Even if the price falls a little, you know you are still safe. Let's take one more simple example. Emma wants to buy a house. She checks the market and thinks the house is worth $1 million. But she decides to buy only if she gets it for $800,000 or less. Why? Because she knows there could be hidden problems, market changes, or unexpected costs. That extra gap protects her. This is the same logic in investing. One important thing to understand is that margin of safety is not always about exact numbers. It is about thinking carefully. It is about asking, what if I am wrong? And preparing for that situation. It is about being cautious, not fearful. Also, this approach may feel slow. You may see others making quick profits. You may feel like you are missing out. But in the long run, safety is more important than speed. Many people lose money because they move too fast without thinking. But those who stay patient and careful often do better over time. This chapter teaches a very practical way to think. It does not promise quick success. It does not depend on luck. It simply says, protect yourself first. If you avoid big losses, your chances of success increase naturally. So what is the final message? Always leave room for error. Always buy with a safety margin. Do not trust your guesses too much. Accept that mistakes can happen and prepare for them. Focus on value, not just price. In the same way, earnings per share is just one number. It is useful, but only if you understand what is behind it. Let's take one more simple example. Suppose there are two companies. Company A shows earnings of $10 per share. Company B shows $8 per share. At first, Company A looks better. But when you look deeper, you find that Company A's earnings include a one-time gain from selling property. Its real business only earned $5 per share. Company B, on the other hand, earned its $8 from regular business. Now which company is stronger? Clearly, Company B. This is why this chapter teaches us to go beyond the surface. Another thing to remember is that the market often reacts quickly to earnings reports. If earnings are higher than expected, prices go up. If earnings are lower, prices go down. But the market is not always right in the short term. People react emotionally. They get excited or scared. They follow headlines. They do not always think deeply. If you follow the crowd without understanding, you become like Mike. You buy when others are excited and sell when others are afraid. But if you think carefully like John, you stay calm. You make decisions based on logic, not emotions. And that is the real power of being an intelligent investor. So what is the final message of this chapter? Do not trust earnings numbers blindly. Always ask what they really mean. Look for regular, consistent, and long-term performance. Avoid getting fooled by one-time gains or short-term tricks. And most importantly, think for yourself. Investing is not about being fast. It is about being careful and clear. If you remember this, you will not get easily confused by numbers. You will see what others miss. And over time, you will make better and smarter decisions. Just like John. Imagine you walk into a shop and see two phones. One looks very shiny and expensive. The other looks simple and a bit boring. Most people will quickly choose the shiny one. But what if the simple one actually works better, lasts longer, and costs less? Now think about the same idea, but with stocks. That is what this chapter is trying to teach. Let's start with a small story. John wanted to invest his money. He saw a company that everyone was talking about. Its stock price was going up very fast. His friend Mike said, "Buy it now or you will miss the chance." John felt excited and a little scared. He thought, if everyone is buying, it must be good. But before buying, he met Sarah, who had more experience. She said, "Don't look at the price. Look at the business behind it." John was confused. He always thought price tells everything. That is where chapter 13 comes in. This chapter explains how to study a company before investing. It is not about guessing or following others. It is about understanding the numbers of a company. These numbers come from something called financial statements. These are simple reports that show how a company is doing. Think of it like a report card for a student. You would not judge a student just by how confident they look. You would check their marks. Same way, you should not judge a company just by its stock price or popularity. The main idea of this chapter is very simple. Before you invest in any company, you must look at its financial data and understand that the business is strong or weak. Price alone does not tell the truth. A high price does not always mean a good company. A low price does not always mean a bad company. Let's break this down in an easy way. Imagine Emma runs a small lemonade stand. If you want to invest in her stand, what would you check? You would ask, how much money does she make every day? How much does she spend on lemons and sugar? Is her profit growing or falling? These are basic questions. Now think of a big company. It is the same idea, just with bigger numbers. The chapter teaches us to look at things like earnings, sales, and debt. Earnings mean how much profit a company makes. Sales mean how much it sells. Debt means how much money it owes. These three things tell a lot about a company. Now let's go back to John. He looked at that popular company again. He checked its earnings and saw that profits were not growing much. He checked its debt and saw that the company owed a lot of money, but the stock price was still very high. That means people were buying it based on excitement, not logic. This is risky. Here comes the first big lesson. Do not trust popularity. A company can be famous and still be weak. Many people buy stocks because others are buying. This creates a crowd effect. But crowds are often wrong because they follow emotions, not facts. A smart investor stays calm and checks the numbers. Let's take another example. Mike bought a stock because it was trending. He did not check anything. For some time, the price went up and he felt happy. But later, the company's poor performance became clear and the price dropped. Mike lost money. On the other hand, John bought a less popular stock. It looked boring, but the company had strong earnings and low debt. Over time, its value slowly increased. John made money, even though it was not exciting at the start. This leads to the second lesson. Focus on long-term strength, not short-term movement. A good company grows slowly and steadily. A weak company may rise fast but can fall even faster. You should think like an owner, not a gambler. When you buy a stock, you are buying a part of a business, not just a number on a screen. Another important idea in this chapter is consistency. A strong company shows stable performance over many years. It does not jump up and down too much. If a company earns good profit this year, but loses money next year, it is risky. But if it earns steady profit every year, it is more reliable. Let's make this simple. Think about two students. One gets very high marks one year and very low marks the next year. The other gets good marks every year. Which one would you trust more? Most people would choose the second one. It is the same with companies. Now, let's talk about something very important. Numbers can sometimes look good, but hide problems. For example, a company might show high sales, but also have very high expenses, so its profit is low. Or it might take a lot of loans to grow quickly. This increases risk. That is why you must not look at one number alone. You must see the full picture. Sarah explained this to John in a simple way. She said, think of a car. It may look great outside, but if the engine is weak, it will not go far. Financial data is like the engine. This helped John understand that appearance can be misleading. Now, John started checking companies more carefully. He looked at their past performance. He checked if their profits were growing. He made sure their debt was not too high. He ignored the noise around him. Slowly, he became more confident. He stopped feeling pressure to act fast. This shows the journey from confusion to clarity. At first, John followed the crowd and felt unsure. Then he learned how to read basic financial data. Finally, he started making decisions based on logic, not emotion. There's also a simple way to think about price and value. Price is what you pay. Value is what you get. Sometimes the stock price is high, but the value is low. That means you are paying too much for something that is not very strong. Other times the price is low, but the value is high. That is a good opportunity. Let's take a simple example. Suppose you see two bikes. One costs more, but is weak and breaks easily. The other costs less, but is strong and lasts long. The second one has more value, even though its price is lower. This is exactly how smart investors think. Chapter 13 is really about building this mindset. It teaches you to slow down, think clearly, and check facts before making a decision. It does not require complex math. It only needs basic understanding and patience. Another small lesson is to compare companies. Do not look at one company alone. Compare it with others in the same field. This helps you see which one is stronger. If one company has better earnings and less debt than others, it may be a better choice. Emma did this with her lemonade stand. She checked how much other kids were earning. She saw that she was doing better because she managed her costs well. This gave her confidence. In the same way, comparing companies helps investors feel more sure about their choices. Now think about how this applies to real life. Many people rush into decisions because they see others doing it. They do not check facts. They follow trends. This often leads to mistakes. But those who take time to understand things usually make better decisions. John learned this the hard way. He almost made a wrong choice. But by learning how to read basic financial data, he avoided a loss. Over time, his small, smart decisions added up. At the end of this chapter, the message is very clear. Do not invest blindly. Do not follow the crowd. Do not trust price alone. Always try to understand the business behind the stock. Look at its earnings, its debt, and its consistency. Think like an owner, not a gambler. If you remember just one thing, remember this. A smart investor is not someone who acts fast. A smart investor is someone who thinks clearly and checks facts before acting. That simple habit can make a big difference over time. Imagine you are about to buy a small shop in your neighborhood. You don't know much about business, but you want something safe. You don't want surprises. You don't want stress. You just want steady money and peace of mind. Now here's the question. How do you choose the right shop so you don't lose your savings? Let's make this simple with a story. John has some money saved. He wants to invest, but he is not an expert. He is busy with his job and doesn't have time to study the market every day. One day, his friend Mike tells him, just pick popular companies. Everyone is buying them. John almost follows this advice, but then he stops and thinks, if it was that easy, why do people lose money? So he starts looking for a smarter way. This is where Chapter 14 of the Intelligent Investor comes in. This chapter is about how a defensive investor should pick stocks. A defensive investor is someone like John. He wants safety, simplicity, and steady results. He does not want to take big risks or spend too much time analyzing everything. The main idea of this chapter is very clear. If you're not an expert, you should follow strict rules when choosing stocks. These rules protect you from making big mistakes. They act like a safety net. Instead of chasing quick profits, you focus on strong, stable companies that have proven themselves over time. Now, let's understand this in a simple way. Think of investing like choosing a player for your team. You don't pick someone just because they had one great game. You pick someone who has played well for many years. You want consistency, not luck. This is exactly what this chapter teaches. The first important lesson is about choosing big, strong companies. Graham says a defensive investor should only invest in large, well-known businesses. Why? Because small companies can fail easily. Big companies have more resources, more experience, and a better chance of surviving tough times. Imagine Sarah wants to lend money to someone. Would she feel safer lending to a stable, successful person or someone who just started working yesterday? The answer is obvious. The same logic applies to companies. But just being big is not enough. The second lesson is about financial strength. A company should not be drowning in debt. It should have enough money to handle its expenses and survive problems. Think of it like a person who earns money but also has too many loans. Even if they earn well, they are always under pressure. A strong company should be able to breathe easily without heavy financial stress. Now comes the third lesson, which is very important. Consistent earnings. A good company should show steady profits over many years. Not just 1 or 2 good years, but a long track record. This shows that the company knows how to manage its business in different situations. Let's go back to John. If he sees one company that made huge profits last year but had losses before that, and another company that made steady profits every year, which one should he trust? The second one, because it shows reliability. Another key idea is dividends. A dividend is like a reward the company gives to its investors from its profits. Graham suggests choosing companies that have been paying dividends regularly for many years. This shows that the company is not just making money, but also sharing it with investors. It also shows discipline. A company that pays dividends regularly is usually more stable. Now let's talk about something many beginners ignore: price. Even a great company can be a bad investment if you pay too much for it. This is like buying a good phone at double price. It's still a good phone, but you made a bad deal. Graham warns against overpaying. He suggests using simple measures to check if a stock is reasonably priced compared to its earnings. Let's make this very simple. Suppose Emma wants to buy a fruit business. One shop earns $10 every day and is selling for $100. Another shop also earns $10 every day, but is selling for $300. Which one is the better deal? Obviously, the first one. Both earn the same, but one is much cheaper. This is how investors should think. So now, John starts following these ideas. He stops looking at hot stocks that everyone is talking about. Instead, he looks for companies that are large, financially strong, and have steady earnings. He checks if they pay dividends and makes sure he is not paying too much. At first, it feels boring. There is no excitement. No big promises. But there is something more valuable: safety. At this point, John faces a common problem. He sees others making quick money from risky stocks. He feels like he is missing out. This is a dangerous feeling. Many people lose money because they chase what others are doing. But John remembers the purpose of his plan. He is not trying to get rich overnight. He is trying to grow his money safely over time. This is where understanding becomes powerful. John realizes that slow and steady growth is more reliable than fast and risky gains. He understands that investing is not about guessing. It is about following logic and avoiding mistakes. Over time, his confidence grows. Another simple but powerful idea in this chapter is diversification. This means not putting all your money into one or two stocks. Instead, you spread your money across many good companies. Why? Because even strong companies can have bad times. But if you own many, one company's problem won't destroy your entire investment. Think of it like having multiple sources of income instead of relying on just one. Now John builds a portfolio step by step. He chooses around 10 to 30 good companies that follow the rules. He does not rush. He does not panic when prices go up or down. He simply sticks to the plan. Let's look at the journey clearly. At the beginning, John was confused and almost followed random advice. Then he learned a simple system based on logic. He understood that safety comes from discipline, not luck. Finally, he built a strategy that he could follow without stress. The beauty of this chapter is that it removes complexity. It does not ask you to predict the future. It does not ask you to find hidden secrets. It simply tells you to be careful, to use common sense, and to avoid obvious mistakes. One more thing to understand is patience. These rules work over time, not instantly. If you expect quick results, you might feel disappointed. But if you give it time, the results become clear. Good companies grow. Their value increases, and your investment grows with them. Think of it like planting a tree. You don't dig it up every day to check if it is growing. You water it, give it time, and trust the process. Investing works the same way. In the end, the message of this chapter is very simple and practical. If you're not an expert, don't try to act like one. Follow clear rules. Choose strong companies. Avoid high risk. Don't overpay. And stay patient. John's story shows that you don't need to be smart in a complicated way. You just need to be disciplined and logical. While others run after quick profits, you quietly build something stable. And that's the real power of this chapter. It teaches you how to protect yourself first. Because in investing, the biggest goal is not just making money. It is avoiding big losses. Once you learn that, everything becomes easier. So next time you think about investing, ask yourself one simple question. Am I choosing based on excitement or based on safety and logic? That one question can change everything. Imagine you walk into a store. Two toys look the same. One costs $100. The other costs $50. Which one would you buy? Most people will pick the cheaper one, right? Now imagine the stock market is like that store. But here, people often do the opposite. They rush to buy the expensive one just because everyone else is buying it, and they ignore the cheaper one, even if it is just as good or even better. This is where most investors make mistakes. Let's start with a simple story. John wants to invest his money. He hears his friends talking about a company that is growing very fast. The stock price is going up every day. Everyone is excited, so John buys it quickly, without thinking much. At the same time, Sarah looks at another company. Its price is not moving much. People are not talking about it, but she checks its business, its earnings, and its value. She sees that it is actually strong and stable, and the price is lower than what it should be, so she buys it quietly. After some time, John's stock crashes because it was too expensive. Sarah's stock slowly grows because it was a good value. This simple story explains a big idea from Chapter 15 of The Intelligent Investor. This chapter talks about something called stock selection for the defensive investor. That sounds like a big term, but it is actually simple. A defensive investor is someone who does not want to take big risks. They want safety, stability, and steady growth. They do not want to spend all day watching the market. They just want a smart and safe way to grow their money over time. Benjamin Graham, the author, gives clear rules for choosing stocks in a safe way. He is basically saying, do not guess, do not follow the crowd, use logic. The main idea of this chapter is that you should choose stocks like you choose anything important in life. You should check quality, price, and safety before making a decision. Now, let's break this down into simple lessons. The first lesson is about buying strong and stable companies. Graham says you should invest in companies that are big, well-known, and financially strong. Think about it like this. If you had to choose between a small shop that opened last month and a big store that has been running for years, which one feels safer? Most people will choose the big store because it has proven itself. In the same way, strong companies have a history of doing well. They have stable earnings. They are less likely to suddenly fail. This does not mean they will grow very fast, but they are safer. For example, Mike is choosing between two companies. One is new and exciting, but it has not made consistent profits yet. The other is older and stable, with steady earnings for many years. If Mike is a defensive investor, he should choose the second one. Why? Because he is not trying to win a race. He is trying to avoid losing. The second lesson is about paying a fair price. Even a great company can be a bad investment if you pay too much for it. This is one of the most important ideas in the whole book. Price matters. Imagine Emma wants to buy a phone. It is a good phone, but if the price is double what it should be, it is not a good deal anymore. The same logic applies to stocks. A company might be amazing, but if its stock price is too high, it becomes risky. Graham suggests using simple numbers to check if a stock is overpriced. One example is the price-to-earnings ratio, also called PE ratio. You do not need to understand it deeply right now. Just think of it as a way to compare price with earnings. If the price is too high compared to earnings, it might not be a good buy. The idea is simple. Do not overpay. Let's go back to John. He bought a popular stock because everyone was talking about it. The price was already very high. He did not check if it was worth that price. That is why he lost money. Sarah, on the other hand, looked for a fair or low price. That is why she had a better result. The third lesson is about diversification. This means not putting all your money into one stock. Graham strongly suggests spreading your money across different companies. Why? Because no one can predict the future perfectly. Even a strong company can face problems. If you invest in many companies, one mistake will not destroy your entire investment. Think of it like this. If you carry all your eggs in one basket and drop it, everything breaks. But if you spread the eggs into many baskets, dropping one will not hurt much. This is simple logic, but many people ignore it. Let's say Sarah has $10,000. Instead of putting all of it into one company, she divides it into 10 different companies. Even if one company fails, the others can still grow. This reduces her risk. Now let's see how these lessons connect in a real-life journey. At first, John is confused. He sees people making quick money. He feels like he is missing out. He thinks fast growth means easy success. So he jumps into the market without thinking. This is the problem stage. He is acting on emotions, not logic. Then he faces losses. His stock drops. He feels stressed and unsure. This is where he starts questioning his approach. He realizes that following the crowd is not a smart strategy. This is the understanding stage. Now John decides to learn. He reads about investing and finds these simple rules. He understands that he needs to choose strong companies, pay fair prices, and spread his money. He stops chasing quick gains. He becomes patient. This is the solution stage. Over time, John's new approach starts working. His investments grow slowly but steadily. He feels more confident because he understands what he is doing. He is no longer guessing. He is making decisions based on logic. This chapter teaches us that investing is not about being smart in a complicated way. It is about being disciplined and logical. You do not need to predict the future. You just need to avoid obvious mistakes. Many people think investing is like a game where you have to be fast and clever. But Graham shows that it is more like a process where you have to be careful and patient. You win not by taking big risks, but by avoiding bad decisions. Let's simplify everything into one clear thought. Good investing is like buying good things at a fair price and not putting all your money in one place. That's it. No magic, no guessing, just simple logic. If you remember one thing from this chapter, remember this. Do not follow the crowd, do not overpay, and do not take unnecessary risks. Think before you act. Check value before price. And stay calm even when others are excited. In the end, the market is full of noise. People will always shout about the next big thing. But a defensive investor stays quiet, thinks clearly, and makes simple, logical choices. That is how real wealth is built, slowly and safely over time. Imagine this. John walks into a store and sees a special offer. He can buy a normal toy for $10, or he can buy a magic ticket for $8 that can later be turned into that same toy whenever he wants. At first, it sounds amazing. Cheaper now, same toy later. But then John thinks, what if the price of the toy drops to $6 later? Then his magic ticket is not such a good deal anymore. This simple situation is very similar to what Chapter 16 of the Intelligent Investor talks about. It explains something called convertible securities and warrants. These are fancy words, but the idea is simple. They are like special deals in the investing world. They promise you that you can turn one thing into another later, usually into company shares. Now let's understand this step by step in a very easy way. First, what are convertible securities? Imagine Sarah buys a bond from a company. A bond means the company promises to pay her interest regularly and return her money later. That is safe and simple. But this bond has a twist. It says that Sarah can convert it into company shares if she wants. So Sarah now has two choices. She can keep earning steady interest like a normal bond, or she can switch and become a shareholder if the company grows and the share price goes up. Sounds like the best of both worlds, right? This is why many people get excited about these deals. They feel smart. They feel like they found a shortcut to earn more money with less risk. But the book warns us. It says, slow down, think carefully, because these deals are not always as good as they look. Let's understand the main idea of this chapter. The chapter teaches us that convertible securities and warrants often look attractive, but they're usually priced in a way that benefits the company more than the investor. They can be confusing, and many people buy them without fully understanding their real value. Now, let's break this into simple lessons. The first lesson is this. A special deal is not always a better deal. Mike sees a convertible bond. He thinks, I get safety from the bond and growth from shares. This is perfect, but he forgets one thing. The company already knows this too, so they price the bond higher. This means Mike is paying extra for that option to convert later. It is not free. He is already paying for the benefit in advance. Think of it like buying a combo meal. You think you are saving money, but sometimes the combo costs more than buying just what you need. So the first key idea is simple. Just because something has more features does not mean it is a better deal. You must always check the price. The second lesson is about uncertainty. These deals depend on the future, and the future is never certain. Emma buys a convertible bond because she believes the company will grow. She plans to convert it into shares later and make a profit. But what if the company does not grow? What if the share price stays the same or even drops? Then her option to convert becomes useless. She is stuck with a bond that she may have overpaid for. This is like buying a ticket for a future event, thinking it will be amazing. But when the day comes, the event is boring. Your ticket had potential, but the reality did not match. So the second key idea is this: never depend too much on what might happen. Focus on what is real today. The third lesson is about complexity. When something is hard to understand, it is easier to make mistakes. Convertible securities and warrants can be tricky. They involve numbers, conditions, and future possibilities. Many investors feel confused, but they still invest because they do not want to miss out. John once heard about warrants. A warrant gives you the right to buy shares at a fixed price in the future. He thought, this is great. If the share price goes up, I win big. But he did not understand how long the warrant lasts, how it is priced, or how the market already includes these factors. So he made a decision based on excitement, not understanding. The book strongly warns against this. If you do not fully understand something, do not rush into it. Now let's bring all of this together with a small journey. At the start, John wants to invest. He hears about convertible bonds and warrants. They sound smart and modern. He feels like this is a shortcut to success. He thinks, why choose between safety and growth when I can have both? Then he learns more. He realizes that these deals are not free advantages. He is paying extra for them. He also sees that their success depends on future events that are not guaranteed. And he notices that the details are complex, which makes it easy to misunderstand. Now John changes his thinking. Instead of chasing smart-looking deals, he focuses on simple, clear investments. He asks basic questions. What am I paying? What am I getting? What is the real value today? This shift makes him a better investor. Let's make it even simpler with a real-life example. Imagine you want to buy a phone. One shop offers you a normal phone for $500. Another shop offers a special plan. You pay $550 now, but you get the option to upgrade to a better model later at a fixed price. At first, the second option sounds better, but think carefully. You're already paying $50 extra, and the future upgrade only makes sense if the new model is truly worth it. If better phones become cheaper later, your option loses value. So what should you do? You compare clearly. You do not get distracted by the extra features. You focus on what makes sense right now. This is exactly what the chapter teaches. Another important idea is that companies use these tools for their benefit too. When a company offers convertible bonds or warrants, it is not doing it just to help investors. It is trying to raise money in a way that is attractive. By adding these special features, the company can make the offer look better, but that does not mean it is better for you. So always remember, every deal has two sides. If it looks too good for you, ask why the other side is offering it. Now let's talk about a simple rule you can follow. If an investment is simple and clear, it is easier to judge. If it is complex and depends on many future conditions, be more careful. Simple does not mean boring. Simple means understandable. The book does not say that convertible securities or warrants are always bad, but it says they require extra care. You must study them properly. You must compare their price with what you are getting. And most important, you must not let the extra feature trick you into paying more than something is worth. In the end, the message is very clear. Do not chase clever-looking investments. Do not get excited by fancy options. Stay calm and think logically. Ask simple questions. What is the real value? What am I paying today? What am I depending on in the future? If you follow this thinking, you avoid many mistakes. So the next time you see a special deal, whether in investing or in daily life, pause for a moment. Look beyond the excitement. Break it down into simple parts. And decide based on clear thinking, not just hope. That is the real intelligence this chapter teaches. Not finding complicated tricks, but staying simple, careful, and logical in every decision. Imagine you are about to buy a used phone from someone. The seller says it is worth $10,000, but you are not sure if it really works perfectly. So what do? You try to get it for $6,000 or $7,000. Why? Because if something goes wrong later, you won't lose too much money. This simple idea can protect you. And this exact thinking is what Chapter 17 of Underscore the Intelligent Investor Underscore is all about. Let's start with a small story. John wants to invest his savings. He sees a company's stock selling at 100 per share. His friend Mike says, "This company is amazing. Buy it now before it goes higher." John gets excited, but then he remembers something important. What if the company is not as great as it looks? What if its profits drop? What if the market changes? So instead of rushing, John waits. He only wants to buy if the price drops to 70. This way, he has a safety cushion. This simple decision can make a big difference. Now let's understand the book idea in a simple way. Chapter 17 talks about one of the most important concepts in investing. It is called the margin of safety. This sounds like a big term, but it is actually very simple. It means you should always leave some space for mistakes when you invest. You should not pay the full value for something. You should pay less than what it is truly worth. Think about it like this. If you believe something is worth 100, you should try to buy it at 70 or 80. That extra gap is your safety. If things go wrong, you still have protection. If things go right, you gain more. The main idea of this chapter is very clear. No one can predict the future perfectly, not even experts. So instead of trying to be perfect, you should protect yourself from being wrong. This is smart investing. Let's break this into simple lessons. The first lesson is that mistakes are normal. Even smart people make wrong decisions. Sarah once studied a company very carefully. She checked its sales, profits, and future plans. Everything looked perfect. She bought the stock at a high price. But after some time, the company started facing problems. Its profits dropped and the stock price fell. Sarah felt bad, but the real mistake was not her research. The real mistake was that she paid too much. If she had bought it at a lower price, her loss would have been smaller. So the lesson is simple. You cannot avoid mistakes, but you can reduce the damage. Buying with a margin of safety protects you when you are wrong. The second lesson is about being patient. Mike is different from John. He gets excited easily. When he hears good news, he buys quickly. When prices go up, he feels happy. When prices fall, he panics and sells. He does not wait for the right price. Because of this, he often loses money. John, on the other hand, is calm. He does not chase prices. He waits for a good deal. Sometimes he does nothing for weeks or months. People may think he is missing opportunities, but he knows something important. Good investing is not about doing more. It is about doing the right thing at the right time. The margin of safety helps you stay patient. When you decide a safe price, you don't rush. You wait until the price reaches your level. This keeps you away from emotional decisions. The third lesson is about thinking like a smart buyer, not like a gambler. Imagine Emma wants to buy a house. She checks the quality, the location, and the price. She does not just buy because others are buying. She makes sure she is getting a good deal. But in the stock market, many people forget this. They buy because prices are rising. They sell because prices are falling. They follow the crowd. This is not smart. The book teaches that you should treat stocks like real businesses. When you buy a stock, you are buying a part of a company. So you should ask simple questions. Is this company strong? Is it making steady profits? Is the price fair? And most important, are you buying it at a price that gives you safety? Let's see how this works in real life. Suppose a company earns good profits every year. You believe its true value is around 200 per share, but the market is offering it at 190. This is not much safety. If something small goes wrong, the price can drop to 150 or even lower. You may lose money. Now imagine the same company is available at 140. Now you have a cushion. Even if things go a little wrong, you are still safer. And if things go well, you can earn a good return. This difference is very important. It is not just about what you buy. It is about how much you pay. Now, let's look at a small journey. At first, John used to think investing was about finding the best company. He spent hours searching for perfect businesses. but he often ignored the price. Sometimes he bought great companies at very high prices, and later he saw losses. This confused him. Then he learned about the margin of safety. Slowly, his thinking changed. He stopped chasing perfect companies. Instead, he looked for good companies at good prices. He became more patient. He made fewer decisions, but better ones. Over time, his results improved. He still made mistakes, but they did not hurt as much. He felt more in control. He was no longer guessing the future. He was protecting himself from it. This is the real power of this idea. It changes how you think. Another important point is that the margin of safety gives you confidence. When the market falls, many people panic. They sell their investments at a loss. But if you bought with a safety cushion, you feel more relaxed. You know you did not overpay. You trust your decision. This calm mindset is very valuable. It helps you avoid emotional mistakes. But there is one more thing to understand. The margin of safety is not a magic trick. It does not guarantee success every time. Sometimes, even a safe investment can go wrong, but it increases your chances of success over time. It reduces risk. And in investing, reducing risk is very important. Think of it like wearing a helmet while riding a bike. It does not stop accidents from happening, but it protects you if something goes wrong. The margin of safety works the same way. Now, let's make it even simpler. Always ask yourself one question before investing. Am I getting enough safety in this deal? If the answer is no, it is better to wait. There will always be another opportunity. Many people lose money because they want quick results. They want fast profits. They ignore safety. But smart investors focus on staying safe first. Profits come later. In the end, the message of this chapter is very clear. Do not try to be perfect. Do not try to predict everything. Instead, protect yourself from being wrong. Always leave a gap between price and value. This gap is your shield. So next time you think about investing, remember John and Mike. One rushed and followed emotions. The other waited and thought carefully. Over time, the patient one wins. The simple truth is this. In investing, you don't need to be a genius. You just need to be careful. Buy with a margin of safety, and you give yourself a strong chance to succeed. Imagine you buy something for $100. After a few days, someone offers you only $60 for it. You feel bad, right? You think, did I make a mistake? But what if that same thing is actually worth $150, and the person offering $60 just doesn't understand its value? Now think about this. In the stock market, this happens every single day. Let me tell you a short story. John bought shares of a company because he believed the company was strong. It had good sales, steady growth, and a smart team running it. But after a few weeks, the price of the stock dropped a lot. John got scared. He thought, maybe I was wrong. His friend Mike told him, sell it before it drops more. So John sold his shares at a loss. A few months later, the company did very well, and the stock price went up much higher than where John bought it. John felt regret. But the real problem was not the company. The problem was how John reacted. This is exactly what Chapter 18 of Underscore the Intelligent Investor Underscore explains in a very deep but simple way. The chapter is about comparing different companies and understanding how to judge them properly. It teaches us that many investors make wrong decisions because they don't compare companies wisely. They either trust too much or get scared too quickly. The main idea of this chapter is simple. You should not judge a company just by its stock price. You should look deeper. You should compare it with other similar companies. And you should use logic, not emotions, when making decisions. Think about it like buying a phone. If you see two phones, one costs $500 and another costs $800, you don't just pick one randomly. You compare them. You check the features, battery life, camera, and performance. Only then you decide which one is worth your money. Investing should be exactly like that. But most people don't do this. They just see a price going up or down and react quickly. The chapter explains that smart investors compare companies based on important numbers. These numbers help you understand how strong or weak a company is. For example, how much profit the company makes, how much debt it has, and how stable its growth is. If a company has high profits and low debt, it is usually stronger than a company with low profits and high debt. This is basic logic. But many people ignore this and only focus on price. Let's go back to John. If John had compared the company he bought with other companies in the same field, he might have felt more confident. He would have seen that his company was actually doing better than others. So even if the price dropped, he would not panic. He would understand that the market is just reacting emotionally, not logically. One important lesson from this chapter is that price and value are not the same. Just because a stock price goes down does not mean the company has become worse. And just because a stock price goes up does not mean the company has become better. Price is what people are willing to pay right now. Value is what the company is actually worth based on its business. Let's take another simple example. Sarah owns a small bakery. Her bakery makes steady profits every month. One day, someone offers to buy her bakery for a very low price. Does that mean her bakery is suddenly bad? Of course not. The bakery is still making the same profit. The offer is just one person's opinion. In the same way, the stock market gives you prices every day, but those prices are just opinions, not facts. Another important lesson is about comparing companies in the right way. You should not compare a small company with a huge company. That would be unfair. Instead, compare companies that are similar in size and type. This helps you understand which one is performing better. For example, if two companies are in the same business and one is growing faster with less debt, it might be a better choice. The chapter also warns about being too impressed by popularity. Sometimes a company becomes very popular, and everyone wants to buy its stock. The price goes up very fast. But when you compare it with similar companies, you may find that it is not actually better. It is just more popular. This is dangerous because you might end up paying too much for something that is not worth it. Think about Mike now. Mike always buys stocks that are trending. If everyone is talking about a company, he buys it without thinking much. At first, it feels good because the price goes up, but later, when excitement fades, the price falls. Mike loses money. If Mike had compared those companies properly, he would have seen that many of them were overpriced. This chapter also teaches patience. Good investing is not about quick decisions. It is about careful thinking. When you compare companies and understand their value, you don't feel the need to act fast. You can wait. You can stay calm even when prices move up and down. Let's imagine Emma. She studies two companies carefully. She compares their profits, growth, and debt. She chooses the one that looks stronger. After buying it, the price drops for a while. But Emma stays calm because she knows why she bought it. She trusts her analysis. After some time, the price rises and she gains. Emma's success is not luck. It is a result of clear thinking. Another simple idea from this chapter is that mistakes often happen when people don't have a clear method. If you just guess or follow others, you'll make emotional decisions. But if you have a simple way to compare companies, you will feel more confident. You will know what you are doing. Think of it like solving a math problem. If you don't know the steps, you will feel confused. But if you know the method, you can solve it calmly. Investing is the same. You need a method. Comparing companies is one of the most important parts of that method. The chapter also shows that even professionals can make mistakes if they don't compare properly. So being smart is not about knowing everything. It is about using simple logic again and again. You don't need to be a genius. You just need to be careful and consistent. Let's connect everything now. John had a problem. He bought a good company but sold it too early because he got scared. The reason he got scared was that he did not fully understand a company's value. He did not compare it with others. He focused only on the price. But once you understand how to compare companies and see their true value, your thinking changes. You stop reacting to every small movement. You become more stable. The solution is simple but powerful. Always look deeper. Always compare. Ask yourself, is this company really strong compared to others like it? If the answer is yes, then short-term price changes should not scare you. If the answer is no, then maybe you should rethink your decision. In the end, this chapter teaches a very practical lesson. The market will always move up and down. People will always have different opinions. But your job is not to follow every opinion. Your job is to think clearly, compare carefully, and make decisions based on real value, not just price. If you remember just one thing, remember this. Don't let price control your mind. Use logic, compare wisely, and stay calm. That is how a simple investor becomes an intelligent investor. Imagine this. You go to a shop to buy a phone. Two phones look almost the same. One costs $10,000. The other costs $25,000. Both can call, message, and use apps. Now the question is simple. Which one should you buy? Most people think the expensive one must be better. But what if it is not? What if the cheaper one gives you everything you need? This simple thinking is exactly what this chapter is about. Let's start with a short story. John is a young investor. He hears about a company whose stock price is going up very fast. Everyone around him is excited. His friend Mike says, "This company is amazing. The price doubled in a few months. Buy it now before it goes higher." John feels the pressure. He does not want to miss out, so he buys the stock at a high price. After some time, the excitement slows down. The stock price stops rising. Then it starts falling. John gets scared. He sells at a loss. Later, he finds out something important. The company was good, but the price he paid was too high. He paid more than what the business was really worth. This is where Chapter 19 of The Intelligent Investor teaches a powerful idea. The chapter talks about how much you should pay for a business. It explains that even a great company can be a bad investment if you pay too much for it. And even an average company can be a good investment if you buy it at a low price. The main idea is simple. Price and value are not the same. Price is what you pay. Value is what you get. If you pay more than the value, you lose. If you pay less than the value, you gain. Let's make this even simpler. Imagine Sarah wants to buy a small shop. The shop earns $100 every month. Now, if someone asks for $1,000 for that shop, it sounds like a fair deal. But if they ask for $50,000 for the same shop, it becomes a bad deal. The shop did not change. Only the price changed. This is exactly how stocks work. A stock is just a small piece of a business. When you buy a stock, you are buying part of a company. So the same rule should apply. You should not just look at how popular the stock is. You should ask, how much is this business really worth? Now, this chapter also talks about something called earnings. Earnings are the money a company makes. This is very important because in the end, a business is valuable because it makes money. If a company earns more, it is usually more valuable. But here is the tricky part. People often pay very high prices for companies just because they expect future growth. They think, this company will grow fast, so it is okay to pay a high price today. Sometimes they are right, but many times they are wrong. Let's go back to John. The company he bought was growing fast, but everyone already knew that, so the price had already gone very high. There was no extra value left for John. He was just following the crowd. This chapter teaches us to be careful about growth stories. Growth is good, but price still matters. If you pay too much, even strong growth may not save you. Now, let's break this into a simple thought. Imagine you buy a fruit tree. If the tree gives you 10 fruits every year, you can estimate its value. But if someone says, this tree might give 50 fruits in the future, and asks for a very high price today, you are taking a risk. The future is not certain. So the smart investor thinks like this. I will not pay a high price based on hopes. I will pay a fair or low price based on what I can see clearly. This brings us to the idea of a margin of safety. Even though this idea is explained more in another chapter, it is connected here. It means you should buy with a safety cushion. You should pay less than what the business is worth. This way, even if things go wrong, you are still safe. Let's take another example. Emma wants to buy a car. The real value of the car is around $5,000. If she buys it for $4,000, she has a margin of safety. But if she buys it for $7,000, she is taking a risk. Even a small problem can cause a loss. In investing, this idea protects you from mistakes. Because no one can predict the future perfectly. Prices go up and down. Businesses change. But if you buy at a low price, you reduce your risk. Now, this chapter also explains something about how people behave. Most people focus on price movement. If a stock is going up, they think it is good. If it is going down, they think it is bad. But this is not logical. A rising price does not always mean a good investment, and a falling price does not always mean a bad investment. What matters is value. Let's say Mike sees a stock falling from 100 to 70. He thinks, this is bad. But John looks deeper. He finds out the company is still strong and worth around 120. Now the price is 70. This becomes a good opportunity for John. So the smart investor does not follow emotions. He uses logic. He asks simple questions. What is this business worth? Am I paying more or less than that? Another important lesson from this chapter is about patience. Good opportunities do not come every day. Sometimes, the market is full of overpriced stocks. In such times, the smart investor waits. He does not rush. Think about shopping again. If everything in the store is overpriced, you wait for a sale. You do not buy just because others are buying. The same rule applies here. Now, let's look at a small journey. John started as an emotional investor. He followed the crowd. He bought high and sold low. He felt confused and frustrated. Then he learned this simple idea. Price is not value. He started studying companies more carefully. He looked at earnings. He compared price with value. He stopped chasing fast-moving stocks. Instead, he waited for good deals. Slowly, his result improved. He made fewer mistakes. He felt more confident, not because he became smarter, but because he started thinking clearly. This is the real power of this chapter. It does not teach complicated formulas. It teaches clear thinking. You do not need to predict the future. You do not need to find the next big company. You just need to avoid paying too much. At the end, the message is very simple. Always remember this. A great business is not always a great investment. The price you pay decides your result. So next time you think about buying something, whether it's a phone, a car, or stock, pause for a moment. Ask yourself one question. Am I paying a fair price for what I'm getting? If the answer is yes, you are making a smart move. If the answer is no, it is better to wait. This simple habit can change everything. Imagine you are crossing a busy road. Cars are coming fast. What do? You don't just step in and hope everything goes well. You look both ways. You wait for the right moment. You keep some distance from danger. That extra care is what keeps you safe. Now think about money and investing. What if you could have that same kind of safety when you invest? That is exactly what Chapter 20 of The Intelligent Investor teaches. It talks about one powerful idea called the margin of safety. Let's start with a simple story. John wants to buy a used bicycle. The seller says it is worth $100. But John looks closely. The tires are a bit worn out. The brakes are not perfect. So John thinks, what if something goes wrong later? Instead of paying $100, he offers $70. That way, even if he needs to fix something, he won't lose much money. John is not being cheap. He is being smart. He is creating a safety gap between price and value. This is the main idea of Chapter 20. The margin of safety means you should buy something for less than what it is really worth. That gap protects you from mistakes, bad luck, or unexpected problems. The book explains that investing is never perfect. No one can predict the future exactly. Even experts make mistakes. A company that looks strong today may face problems tomorrow. So instead of trying to be perfect, a smart investor focuses on being safe. Think of it like building a bridge. If a bridge is expected to carry 1,000 kilograms, engineers don't build it exactly for 1,000 kilograms. They build it stronger, maybe for 1,500 kilograms or more. Why? Because they know there can be extra load, wind, or damage. That extra strength is the margin of safety. In investing, the same idea applies. If a stock is truly worth $100, a smart investor tries to buy it at $70 or $60. That way, even if the value dropped a little or the estimate was wrong, the investor is still protected. Now, let's break this down into simple lessons. The first lesson is that price and value are not the same thing. Many people think if something is expensive, it must be good, and if something is cheap, it must be bad. But this is not always true. A stock price can go up just because people are excited. It can also go down even if the company is still good. Let's take Sarah as an example. She sees a popular company. Everyone is talking about it. The price has already gone very high. She feels excited and buys it at a high price. But later, the excitement fades and the price drops. Sarah loses money, even though the company is still okay. Now look at Mike. He looks for a company that is not very popular right now. The price is low, but the company is still strong. He buys it at a lower price than its real value. Over time, the market realizes a true value, and the price goes up. Mike makes money, not because he gets a future, but because he bought with a margin of safety. The second lesson is that mistakes are normal, so protection is important. Even if you study carefully, you can still be wrong. Maybe you thought a company would grow, but it didn't. Maybe something unexpected happened. The margin of safety gives you room to be wrong without losing too much. Think about Emma, who wants to invest in a small business. She believes it can grow, but instead of putting all her money at a high price, she waits for a better deal. She invests only when the price is clearly lower than what she thinks it's worth. Later, even if the business grows slowly instead of quickly, she still doesn't lose much because she bought at a safe price. Without that safety gap, even a small mistake can cause a big loss. But with it, the same mistake becomes small and manageable. The third lesson is about patience and discipline. The margin of safety is not always easy to find. Sometimes, the market is full of high prices. Everything looks expensive. In such times, a smart investor does not rush. They wait. This is where many people fail. They feel like they are missing out. They see others making quick money. So they jump in without thinking about safety. But this often leads to losses. Let's go back to John and the bicycle. If the seller refuses to lower the price, John simply walks away. He doesn't force himself to buy. He waits for a better deal. Later, he finds another bicycle in better condition for $65. His patience pays off. In investing, the same thing happens. You don't need to buy all the time. You only buy when there is a clear margin of safety. Now, let's see a small journey to understand this better. At the start, many beginners think investing is about finding the fastest growing company. They look for trends. They follow tips. They chase what is popular. This is the problem stage. It feels exciting, but it is risky. Then comes understanding. Slowly, they realize that price matters more than excitement. They see that even a great company can be a bad investment if the price is too high. They start to think in terms of value, not hype. Finally comes a solution. They begin to use a margin of safety. They only buy when the price is clearly lower than the value. They accept that they cannot predict everything. Instead, they focus on protecting themselves. This shift is powerful. It changes investing from guessing to thinking. Another important idea in this chapter is that the margin of safety works best when combined with careful thinking. It is not about randomly buying cheap things. Something can be cheap because it is truly bad. So you still need to check if the company is strong, stable, and makes sense. Think of it like buying food. If something is very cheap but spoiled, you should not buy it. But if it is fresh and good, and you get it at a lower price, that is a great deal. The margin of safety works the same way. Also, the book reminds us that the future is always uncertain. There will be ups and downs. Markets will rise and fall. But if you always keep a margin of safety, you can survive tough times and grow long term. Let's simplify the whole idea into one clear picture. Imagine you are packing a bag for a trip. You don't pack exactly the amount of food you think you will need. You pack a little extra, just in case. That extra is your safety. It gives you peace of mind. In investing, that extra safety comes from buying below value. It is not about being greedy. It is about being careful and smart. So what is the final message of Chapter 20? Always leave room for error. Never depend on perfect predictions. Focus on buying with a margin of safety. This one habit can protect you from big losses and help you grow your money slowly and safely. If you remember just one thing, remember this. Don't try to be right all the time. Try to be safe all the time. That is what makes a real intelligent investor. Thanks for watching. If you found this helpful, make sure to like, share, and subscribe for more videos like this.